Hello and welcome to the next of our full course lectures. This lecture begins where we left off in the last lecture. We understand that there are different transactions we need to record. We're going to look now at how to actually record them. We're going to look at double entry bookkeeping. We're going to learn our debits and credits, and we're going to look at various entries that we need to remember and we need to know how to do. Don't forget you can download all of our mind maps shown here for free on our website www.mapitaccountancy.com. So double entry bookkeeping, first of all, what is it? What are we looking at here? Well, each transaction has two effects. We know that from the previous session. It may be that there's a transaction that affects the statement of financial position and the income statement, or it may affect two areas on the statement of financial position. Each of those will be a debit and a credit. So for every debit that occurs, there will be an equal and opposite credit. So it might be that we're debiting the statement of financial position and crediting the income statement. Or it might be that we're debiting one area of the statement of financial position and we're crediting another area. It doesn't really matter as long as the debits equal our credits. And what that means is it will ensure that our statement of financial position balances. It also ensures that our accounting equation holds true. So it makes our statement of financial position balance because for every debit we have a credit, so they will cancel each other out and make sure that it always balances. And the accounting equation will always hold. Remember, it was that our assets equals our capital plus our liability. Well, we're going to learn now that assets are a debit balance and both capital and liabilities are credit balances. So if we debit our assets with 10, well, we'll be crediting our capital or liabilities with 10 as well. So therefore, they're cancelling each other out and the balance remains. So each transaction that we look at will have a debit and a credit. That will make sure our statement of financial position balances, and it will ensure that our accounting equation always holds true. That's why we're doing it. So what do we need to learn? Well, the first thing we need to learn is this table. So you need to know that to increase assets, we debit them. To increase expenses, we debit those. Whereas to increase our liabilities, we credit those. To increase income, we credit them. So our assets are a debit balance, our liabilities are a credit balance. So to increase our assets, we debit them. To increase our liabilities, we credit them. And when we're thinking about the income statement, the expenses in our income statement will be debits, and the income in our income statement will be a credit. So sales will be a credit, wages will be a debit. So you need to learn that table. I tend to think of it as learning one thing on each. So what I always remember is that assets are a debit balance. That tells me on our statement of financial position that the liabilities will be a credit balance. So will our capital. For our income statement, I think, well, sales are always a credit, and that tells me what everything else is. Sales are a credit, that means our expenses must be a debit. So always remember that your assets are a debit and your income is a credit, and that should enable you to work everything else out. So what we're going to do here is we're going to look at how you would actually record these transactions. Now, these days, this will all be done on a computer, but we need to understand what a computer is actually doing. So we're going to look at how to do books and bookkeeping manually first of all, and then you will understand what that computer system is processing, what the transactions are. So what we're going to do is we're going to create a ledger account. So it's going to look like this. It's sometimes called a T account because you can see the T in the middle there. And the name of the account will go at the top. So this could be a sales ledger account. And the debits will go on the left with the credits on the right. So if we were posting into that, we would put the details of the transaction and the amount. If it was a debit entry, we would put whatever that entry was and the amount on the debit side. If it was a credit entry, we would put whatever that was and the amount on the credit side. So that's how we will record all of our items. So we'll need a ledger account for each item in our financial statements. So we'll have one for each of the accounts on our statement of financial position. So we'll have a ledger account for property, plant and equipment. We'll have a ledger account for inventory. We'll have a ledger account for receivables. And we'll have an account for each item on our income statement. One for wages, one for any other expenses, one for our sales. So we'll have a ledger account for each of them. We use that to record the debits and the credits as they happen. And this really is for record keeping. This is how you would run a manual bookkeeping system. These days, this will be done on a computer, but the computer is really processing these same things that we're looking at. So let's see how we would actually go about doing this. Let's look at some transactions and see how we would record them. What we're going to do is we're going to work through illustration 1 for everything that we look at from here on in, because it will build up to show you how this system makes the records, keeps the records, and how everything interlinks. Now, for the exam purposes, what I need you to do is to learn all the debits and credits that we're going to look at here. So we're going to look at sales, purchases. We're also going to look at returns, discounting, and then we'll look at what's called a trial balance at the end. So all of this is important for the exam. You need to remember it, so you need to try and learn this as we go. So we're going to talk about each transaction and then we'll post it into our illustration 1 to see how it actually happens. So the first thing we can talk about is introducing capital. If you start a business requires some capital to begin. So what we'll have to do is introduce that capital as the owner of the business. Now, how would that happen? Well, that would happen by debiting cash, because cash is an asset. It appears at the top of our statement of financial position, and we learnt that to increase an asset, we debit it. So assets are a debit balance. To increase them, we debit them. So debit cash, and we credit capital. Remember, capital appears down at the bottom of our statement of financial position. It is a credit balance. Capital and liabilities are both credit balances. So to increase the capital that's been introduced, we need to credit it. So there's our two entries: debit cash, credit capital. So let's look at illustration 1 and see how this would be recorded, because in note 1 of illustration 1 we have some capital introduced. So let's look at that and see how we would go about recording this transaction. So we're looking here at illustration 1 for this lecture, and we're told that Jim decides to start a small business that he will run himself as a sole trader. The following then occurs, and we have various transactions. So we need to learn how to deal with each of these transactions. The first one is that capital of 20,000 was introduced by Jim. So, what we're going to do is we're going to record all journals here. Then we're going to post to individual ledgers. So we're going to create a ledger account for each area of the financial statements, and we'll post them in. So this is just to record what the transaction is. So we have the note, as in what note it refers to, and the debit and credit entries that we require. So for note 1, we're going to debit cash with 20,000, because we just said that to introduce capital, we debit cash, and the credit will go to capital introduced. So debit cash 20,000, credit capital introduced. Both of those given to us in note 1 because capital of 20,000 was introduced by Jim. Little bit of a note below that just to say what it is. So this is capital introduced by Jim. So what we're doing is we're recording the journals. So this isn't posting them. This is just recording them so we can keep track of it. Now we're going to open up the individual ledgers. So we'll need a cash account and we'll need capital introduced account. And we'll post in the debit cash and the credit in capital introduced. So let's do that now. So looking first of all at our cash ledger. So we said in the session that we'll have a T account, which is what this is. We'll have the debits on the left and we'll have the credits on the right. And what we'll do is post in each thing that we come to. Well, the first thing that we came to, and we just met it, was that capital of 20,000 was introduced by Jim. And we said that that is going to be a debit to cash. So this is us actually recording the transaction. So capital introduced will be debited to our cash account. So this is our cash account. It's a ledger account. And we have now recorded our first transaction. We have debited cash with 20,000. However, we know that you cannot have a debit without a corresponding credit. And the credit was to capital introduced. So what we need to do is set up a ledger account for capital introduced, and we will post that transaction in there also. Our capital account then will look like this. Again, it's a ledger account, so we have the debits and the credits. And we said that the second bit of that transaction was to credit capital with capital introduced of 20,000. So there's capital introduced. It's referenced to note 1 so that we can keep track of it, and it's 20,000. So that's what we're going to do with each transaction that we have. And I know this is quite long and laborious, but that's what we have to do. We write it down in our recording of the journal so that we know what we're going to do. And then we post it into our ledger accounts. So this is the ledger account for capital. If we come to a ledger account that we haven't created yet, we'll have to create one like we just did for capital and then post the item in. So we're going to work through each thing that we come to in this same way. So let's go back and look at what the next item we need to deal with is. So we now know, number 1, how to record our journal entries. Number 2, how to open up our ledger accounts and post those journals into the ledger accounts. And now we need to move on to look at the rest of the transactions that we have. So we've got various transactions that Jim has undertaken. We're going to learn what the debits and credits are, and then we're going to post that into our illustration 1 as we go along. So the next one is purchasing goods. To purchase some goods, well, we know that expenses in our income statement are a debit. So we're going to debit purchases, credit cash with that amount. So we debit purchases because the expenses will go up, and we credit cash because cash will go down. Remember, cash is a debit balance, it's an asset, so to reduce it, we will credit it. So let's post that into our illustration 1 now. So we've already dealt with our capital introduced. We now have to deal with our purchase of goods. So note 2 tells us that goods were purchased for $3,000 for resale. So we're going to record our journal here. So this is just to say what we're going to do so that we can keep track of it. And then we'll post it into the ledger accounts for those items. So number 1, we're going to debit purchases. So we're debiting purchases with 3,000 because remember, purchases are an expense. So we'll debit purchases 3,000 and we'll credit cash with 3,000 also. Remember, that's reducing cash. We paid for them with cash. So therefore that will reduce the amount of cash we have. Cash is a debit balance, so to reduce it, we credit it. And just a little note to say what that is, that's purchases bought for cash. We're really ignoring inventory at this point, by the way. We'll come to that later on in the course. So let's go to the ledger accounts. We've already got a ledger account for cash, and we'll have to create a new one for purchases. So let's deal with the purchases first and then the cash. So for our purchases, we don't have a ledger account yet. So we'll create one. So we need the debits over here, the credits over here. And we just said that we will debit purchases for note 2 with 3,000. And the credit to that was to cash. So we've already created a ledger for cash. Let's go to it and post in our purchases. So here we have our cash account. We already have capital introduced. And now we post in the second item, which is the purchase of goods from note 2, which was 3,000. So you can see we had the debit entry from the last item. We've now got a credit entry. This is just keeping track and recording all of the transactions that we make. So we've dealt with note 2. We can now move on to the next item. The next transaction we need to deal with is the sale of goods. So sale of goods, this time we're going to credit sales on our income statement. Remember we said when we were looking at our debits and credits that income is a credit entry in our income statement. So credit sales, debit cash received. So we've sold goods for cash. That means our cash is going to increase. It's a debit balance. To increase a debit balance, we debit it. So credit sales, debit cash received. Let's do that for illustration 1. So we're now looking at note 3, and note 3 tells us that sales of 4,000 were made for goods that had cost 2,500. So sales of 4,000 were made for goods that cost 2,500. Well, it's really just the sales we need to deal with here. We're ignoring inventory for these purposes. So here we're going to debit cash because we got 4,000 in cash for the goods, and we're going to credit sales with 4,000. Remember, you need to learn your debits and credits. Our sales income is a credit, so to increase our sales we credit them. So we're going to debit cash 4,000, credit sales 4,000. And just a note that that is being the sales of 4,000 in note 3. So let's do that in the ledger accounts. We've got one already for cash. We'll have to create a new ledger account for sales. But let's deal with the cash first of all. So here we have our cash account. We have the capital introduced in note 1, the purchase of goods in note 2. We now have the sales from note 3, and it was debited to cash to increase the amount of cash in the business. So sales from note 3 are debited to cash and the credit goes to sales. We don't have a sales ledger account yet, so we need to create one. So to create our sales ledger account, same as usual, we have the debits on the left, the credits on the right. And we said that we were going to credit sales with 4,000. So that's what we do in our ledger account. There's our sales for cash for 4,000. So let's move on now to the next item. We now have some more expenses that Jim has paid, and the entry for any expenses that have been paid in cash will be to debit the expense on the income statement. So remember, that is a debit balance. It's a debit amount, so we debit it and then we credit cash. Remember, cash is a debit balance, so to reduce our cash, we credit it. The next item we need to deal with is in note 4, we're told that rent was paid at a cost of 700. So rent was paid at a cost of 700. That means we need to debit rent with 700 because it's an expense. Expenses are a debit. And we'll need to credit cash. Well, we know by now that crediting cash will decrease it. We've paid out some cash, so we need to decrease that amount. So that is the rent paid of 700. Let's post this to the ledger accounts. So we have no account for rent paid yet. So we create a new ledger account and we said that we need to debit in the rent paid from note 4 of 700. So debit rent paid with 700. We now need to deal with the cash, so let's post that into our cash account. So far in our cash account we have the capital introduced, the purchase of goods and the sales. We also now need that rent paid to be posted in from note 4. So the rent paid was 700 and it is credited to cash. So that is us posting that amount into our ledger account. So again, remember what we're doing here is creating a ledger account for each item in our financial statements, and then we're posting in the transactions as they happen. So let's move on to the next item in our session. The next item that we're going to deal with is the purchase of the asset. Well, we know assets are debit balances, so to bring that asset in, we will debit the non-current asset. So debit the asset and credit cash with the amount we paid for it. So debit the asset, credit cash. Remember, crediting cash will reduce that amount of cash. So let's do that for our illustration. In note 5, we're told that a non-current asset has been purchased for 10,000, and we know that the entries here are to debit the asset and credit cash. So let's do that. We'll need to create an account for the asset. We've already got a cash account, so we can post in the 10,000 to that. So that is the asset purchased for cash. So we create a new ledger account for the asset. Debits on the left, credits on the right, and we have a new current asset, and that will be a debit balance. So to increase it, we debit non-current asset from note 5 with 10,000, and the credit will go to cash. So let's post that into our cash account. So here we have our cash account. We have the 4 items already recorded, and now we need our non-current asset from note 5, and it was 10,000. So we can now move on to the next item in our session. The last item we need to deal with is the withdrawal of funds. Remember, this is drawings. It's not an expense. It's an amount withdrawn from profit. So it's drawings of profit that the owner has done. So for this, we will credit cash because cash has been reduced. So to reduce cash, we credit it. And we'll debit capital with our drawings. Remember, the profit for the year will increase the capital in the business. If we're drawing off some of that profit, that will reduce it. Capital is a credit balance, so to reduce it, we will debit it. So let's do that for our illustration. The next item that we're looking at is note 6. And in note 6, we're told that Jim took $500 of drawings from the business. We now know that the entries for drawings are that we will debit our capital and credit cash. So we will debit drawings, which is our capital account, and we will credit cash. So let's keep track of the drawings in a separate account. Let's create a ledger for drawings, and then we'll post the 500 to cash also in the account we've already created. So creating our drawings account, we have our debits and our credits, and the only entry so far is our cash drawings from note 6 of 500. So they are debited to drawings, the credit is to cash, so let's post that into our cash account. So we can see all the items we have so far in our cash account. Let's now post in the cash drawings from note 6 of 500. So we can see that we're building up quite a few transactions in our cash account. But we're now able to move on to the next part of our session. So we can now deal with all of the basic transactions that we need to undertake. And as I said, you need to learn each of those to know how to deal with it and how to post it. But keep track of it, write the journal out first and then post it into the ledgers. What we're going to do now is to move on to look at other areas and post those into our illustration also. For example, returns. So two types of returns. The first is where the customer returns unwanted goods. So we've sold some goods to them. They return them. What are the entries for this? Well, what we will do is we will debit sales returns and we will credit cash or receivables. So we're really reversing what we did. We're debiting sales returns. So we'll have a new account called sales returns, which we will net off against sales later on. And we will credit cash or receivables, depending on whether that person paid in cash or we had created a receivable where they owed us that money. So if the customer returns unwanted goods, that's the transaction that we deal with. Or we could have a situation where the business returns unwanted purchases. So rather than the customer returning goods to us, we have bought the goods, we want to return them to the person we bought them from. To deal with that, what we do is we debit the payables or cash. So if we paid cash for the goods, we'll debit cash because we'll be getting that cash back. So that will increase the cash. Or if we had created a payable because we hadn't yet paid for the goods, we will reverse that payable by debiting it. And the credit will be to purchase returns. So we'll need an account called purchase returns and we'll credit that account. So let's see if we can deal with each of these. Let's look at illustration 1. Let's record the journal entry and post these into the correct ledger accounts. We're now able to deal with notes 7 and 8. So in note 7, a customer returns goods for $50. And in note 8, Jim makes unwanted purchases or returns unwanted purchases for which he had paid $80. So first of all, for note 7, we're going to debit sales returns with 50. So we'll need a new sales returns account. And we will credit cash with 50. And that's the return of the goods that we sold. For 8, we'll debit cash and credit the purchase returns account. So we'll need to create that ledger account. And that is the returns of the goods that we purchased. So those are the entries. Let's now create a sales returns account and a purchases returns account, post those in, and then also post them into our cash account. Creating our new sales returns account then is the same as usual with our debits and credits. We then just need to post in the cash that we got for our returned sales in note 7. So debit sales returns and we'll credit cash with that amount. But let's just open up our purchase returns as well before we post our 2 entries into cash. So for our purchase returns, we open it up the same as usual. And this time we are crediting our purchase returns with the returns that were made of $80. So credit here, debit cash. So we can now deal with the 2 entries to cash for our sales returns from note 7 and our purchase returns from note 8. So we can see all the amounts in cash so far that we've dealt with. We now need to bring in our sales returns from note 7, which were credited to cash for 50. So we debited sales returns, credited cash. And then we need to bring in our purchase returns, which were debited to cash for 80 with the credit to the purchase returns account that we just dealt with. So now we know how to deal with returns, either the customer returning unwanted goods or the business returning goods that they had previously purchased. Moving on then to discounts. So again, there are 2 different types of discount we need to learn about. Number 1, we could receive trade discounts. Now, what are trade discounts? This is where you're purchasing from a supplier. And what you might do is buy in bulk from that supplier. Now, because you're buying a lot, well, what they can do is maybe give you a discount for buying that amount. Or it may simply be that they've given you a special discount for your first order or for ordering from them for a long period of time. However this is done, what you need to do is for the discount, record the purchase or sale at the discounted amount. So where we've received a trade discount for buying in bulk or a special discount, we record that purchase or sale at the discounted amount. So let's just check that we can do that for illustration 1. We can now deal with note 9, where we're told that Jim makes sales with advertised price of $100 at a discount of 10%. So this is a discount which is a trade discount, so it's a special discount of some sort, and what we do is we simply record it at the discounted amount. So it was a sale, we're going to make it at the discounted amount, so we will debit cash with the $90 we received, and we will credit sales with the discounted amount of the sale. So we'll debit cash with 90, credit sales with 90, being sales at a discounted value. So we have already got ledger accounts for each of those. Let's post in our 90 to cash and post in our 90 to sales also. Debit cash, credit sales. So our sales account looks like this at the moment. We made sales previously in note 3 for 4,000. We're now bringing in the discounted amount of sales. So the discounted sales from note 9 were 90. So we bring those in at 90. Remember that the debit will go to cash. So let's post that into our cash account. So here we have our cash account with all of the items that we've posted in so far. We now bring in those discounted sales from note 9. So debit cash with $90 for the discounted sales. So that's how we deal with trade discounts. So we take the discounted amount and we post that amount in as our sale. We need to separate our trade discounts from what's called early settlement discounts. Trade discounts, well, we never record the sale at the undiscounted amount. We simply take the discount off and record the sale at that amount. However, for an early settlement discount, well, we're not guaranteed to get it. So these may either be allowed by us or received. And what they mean is that if you pay the bill early, you get a discount. So if you pay within 30 days, perhaps maybe you get a 2% discount. If you pay later than 30 days, well then you pay the full amount. Now the thing is here, we don't know whether we're going to get that or not. So it might be allowed by us, or indeed we might be giving that discount to someone else. So for discounts allowed, what we do is we debit a discount allowed account. So we create a new ledger account. It's called discounts allowed. It's an expense because it's costing us something. So we debit discount allowed and we credit the receivable. So we debit the discount allowed and we credit the receivable. If it's a discount that we received, well, this time we need to debit payables with the amount of the discount and credit discount received. So what we're effectively doing there is we're reducing the amount of the payable and we're creating a discount received ledger. Effectively, it's an income to us. So debit payables, credit the discount received to record that. So you need to check whether the discount has been allowed by us or whether it has been received by us. If it's allowed, we debit that discount allowed with the amount of the discount and we credit receivables to reduce receivables by that amount. If it's a discount received, well, we debit payables to reduce our payables by that amount and we credit a discount received ledger account, and effectively it's treated as income to us. So let's see if we can deal with those. Let's deal with that for illustration 1. We can now deal with the last two notes. We can deal with note 10 and 11. Note 10 tells us that Jim purchases goods worth $500 on credit. So that's pretty simple. We will debit the purchases 500 and credit a payable of 500. So that will be the purchase of the goods on credit. So we'll have to create a ledger account for the payable. We already have a purchases account, so let's post that transaction in. So far in our purchases account, we have note 2 with purchases of 3,000. We can now add in the purchases on credit of 500 from note 10. So debit purchases, credit a payable, in fact. So debit purchases, credit a payable. So we'll need a new ledger account for that payable. So our new account for payables will look the same as the rest. Debits on the left, credits on the right. And we have to post in now the purchases on credit. So we have a payable created of 500. Debit our purchases, credit that payable. So we can now move on to note 11. In note 11, we're told that Jim pays for the $500 worth of goods and gets a 5% discount for early payment. So here we have an early settlement discount, and this is a discount that Jim has received. So first of all, we'll debit the payable credit cash with 475 because he's actually paid for the goods, but he didn't pay 500, he only paid 475. The rest of it, well, that was a discount. So we'll debit the payable with 25 to remove the rest of it. And we credit our discounts received account. So we'll need to create a new ledger account for discounts received. So that's how we deal with the discount on the purchases. We debit payables with the amount we actually paid. We then debit it with the discount we received. And we credit cash with the cash we paid. And we credit discounts received with the 25, the rest, the discount that we got. So let's set an account up for discounts received, and then let's post all of this through. So our discounts received account will look like this, and we simply need to put through the discount that we got on our purchases in note 11. So we said we would credit discounts received. We now need to deal with the payable itself. So far in the payable, we have simply the purchases made on credit. We now need to post through the cash that was paid of 475, debited, as we said, to the payable. And the rest of it is the discount received, the 25. And you can see that we have therefore removed that payable in total of 500. The last thing we need to post through here is the cash that we paid. So let's go to our cash account and do that. So far we have these transactions in our cash account. The last thing we need to post through is our payables payment from note 11. And we said we would credit cash with the 475, the actual amount of cash that we paid. So that's how we deal with the discount. In this case, a discount received for early payment. So now we know how to deal with most of the accounts that we're going to come across. So we're going to look in more detail later on at things such as inventory and receivables, but we know now that we have to have a debit and a credit that equal for every transaction, and we know how to record the journal entries in a list, and then how to post those entries into ledger accounts. Now, what do we do at the year end? Well, at the year end, all of the ledgers are closed off for the year. So what we need to do is we need to get closing balances on all of those accounts. Those closing balances will form our financial statements. So we'll have a closing balance on our assets, for example, our non-current assets or property, plant and equipment. Well, once we've closed that off and got that balance, that's the amount that will appear for our non-current assets in our final financial statements. So we need to learn how to do this for our T accounts or our ledger accounts. So what we do is that we add up both sides of the ledger, i.e. we add up all of the debits that we've posted in and we add up all of the credits that we've posted in. Now those, generally speaking, won't equal each other. So what we're looking is for the larger total, whether our debits come to more than our credits or our credits come to more than our debits. So we add it up and find the larger total. So what we'll do is put the larger total at the bottom of each side. So let's start doing this for our cash account that we have in our illustration 1. So let's start to balance it off. Let's start by adding up each side, the debits and the credits, and finding the larger total. So here we have all of the entries that we created for our cash account. Now what I said was that we're going to add up both sides of the ledger to find the larger total. So if you look at the debit side of the ledger, well, we can see that it is likely to come to a larger amount than the credit side because there's a big 20,000 in there, whereas the biggest amount on the credit is 10,000 and there's nothing else to get it up towards that 20,000. So the larger column will be the debits. So if we add it up, 20,000 plus 4,000 plus 80 plus 90, it will come to a total of 24,170. And we said we're going to put that amount at the bottom of each of our columns, the debits and the credits. Now, so I know that seems silly because when we put it in there at the bottom of our credits, well, it doesn't add up, but we'll come to that. The actual total for the credit column is 14,725 if you add up the 3,700, 10,000, 550 and 475. But we'll come to how we deal with that. So at this stage, we simply add them to get the larger side. It might be that you have to add up both to get that. When you get the larger side, put that amount under each of the columns. Okay, even though one side then doesn't add up, we can then go on to deal with that problem. Now, so far we've seen that we've put the larger total at the bottom of each side. Now, what that means is that one side won't add up because we have the larger total. It's only because one side has been added to that amount. So what we need is a balancing figure to make sure that each of the sides add up. That is the closing balance that we're looking for, and we're going to call it the balance carried forward. So let's do that for our cash account. We've already got the larger total at the bottom of each side. One side now isn't going to add up. We need the balancing figure to find out how to get it to add up, and that's the closing balance that we're looking for. So to finish off our cash account, well, we said that the total for the credit column was actually 14,725, not 24,170. So to make it balance, we need to put a balancing figure. We're going to call that the balance carried forward, and we can see in the credit column that it is 9445. So 9445 is our balance carried forward. We now take that down to the other side. So we bring it across to the debit side and put it under the 24,170 and call it the balance brought forward. That's the amount we're looking for because remember, cash, for example, will be a debit balance. It's an asset, it's a debit balance, so we need it to be on the debit side. So once you've got that balancing figure, the balance carried forward, bring it over to the other side and right down to the bottom below the two totals, and that's the amount that we're looking for. So the process is add up the columns to get the larger total. Put the larger total in for each of the columns. You'll need a balancing figure then in one of the columns to make it balance. That's the balance carried forward. Bring it down to the other side, and that's the balance brought forward. And that's the amount that we are going to be using. So now that we know how to balance that off, we close the account by putting the amount that we got for our carried forward amount below the ledger on the opposite side. That turns it into the balance brought forward for next year, and that's the amount we're looking for our financial statements. So let's go through illustration 1, and what we're going to do is we're going to balance off each and every ledger account that we've created. You might want to pause the video and have a go at it yourself. We've already done the cash account, so you should know how to do the rest of them. So if you go through each of them, balance them off the way that we did with the cash account, and then work through them with me so that we can see that we've got the right amount for each of the ledgers. So we have already balanced off our cash account. We're going to go through now and balance off all of the other accounts that we opened. So all of the ledgers that we have, we're going to balance them off and get our balance brought forward. So for our capital account, well, we only had one entry, the capital introduced. So that meant that our two columns would add up to 20,000. The carried forward, the balancing amount is 20,000. So the brought forward figure will be 20,000 on the capital account. For our sales account, we had our amounts of 4,090. So adding it up, there's only one side in there, so it comes to 4090. So the carried forward balance on the debit side, 4090, and we bring that forward to the other side underneath, 4090. For our purchases, well, again, we only had debit entries, so adding those up, we get 3,500. Put that total in on the debit and the credit side, and the carried forward balance on the credit side will be 3,500. Bring that forward over to the other side underneath the totals, and we have a brought forward balance of 3,500. For our rent account, again, we only have one entry, which was 700. So the totals will be the 700, and the carried forward balance will be 700 on the credit side with the brought forward balance of 700 on the debit side. For our asset, well, we purchased an asset for 10,000. That was the only entry. So when we add up the debit column, it's 10,000. Put that amount into both the debit and the credit column. The carried forward balance on the credit side will be 10,000, and we can bring that forward over to the other side for 10,000 on the debit side. For drawings, we had cash drawings of 500. Add them up, we get 500 for our large total on each side. The carried forward balance on the credit side is 500. So we can bring that across to the other side underneath for a brought forward balance on the debit side of 500. For our sales returns, again, one entry giving us totals of 50. Carried forward balance on the credit side 50. Bring it forward over to the other side, 50 of a debit. For purchase returns, the opposite. So we have a total of 80. The carried forward on the debit is 80. So we bring that forward over on the credit side for 80 as a total. Lastly, our payables. Well, we had our purchases on credit, which were 500. We had cash paid 475 and 25. Well, when you add both sides up, they both come to 500. So in fact, the payables column balances at 500 and there's no carried forward figure. We also need to deal with our discount received. We had our discount on our purchases for 25. That gives us the total on our two columns of 25, and that gives us a carried forward debit of 25 brought over to the other side for a brought forward credit of 25. So now that we have balanced off all of our ledger accounts, we're going to create what's called a trial balance. Now what this trial balance does is it checks that our debits and credits are all correct. Because remember, our debits should add up to the same as our credits. So that's exactly what we're doing here. We're doing a trial to see if it all balances, and we're calling it a trial balance. So we're going to have a column, as we can see here, one for debits and one for credits. Sales, for example, will be a credit balance, so we'll bring it in on the credit side. Rent will be a debit, non-current assets will be a debit, as will inventory and cash. Everything that we have balanced off, so all of the accounts that we have balanced, we'll bring in here. And remember, it's to check our debits and credits. So bring all of the balance brought forwards here from each ledger account. Make sure you get them on the right side, the debits and the credits. And then we should be able to add up both sides and make sure that they are equal. It's a trial balance, so it should all balance. Your debits should equal your credits. So this is a chance for us to check that. And if it doesn't balance, we know that something has gone wrong, and we can go in and check to make sure what the problem is. Then when we move on to next year, well, the balance brought forward is going to be the opening balance for our assets and liabilities. So we've got our balances brought forward into next year. And then for the income statement accounts like sales and expenses, we don't carry the opening balance forward. Because remember, we're only looking in the income statement for the amounts in each year. So we'll have seen what the accounts were for last year. We don't bring that balance forward. We bring it forward at zero again. So no opening balances are brought forward on income statement accounts, but they are brought forward on assets and liabilities. So let's see if we can create a trial balance for our illustration 1. We've already balanced off all of the ledgers, so all you have to do is create a trial balance with the item, the debits and the credits, and then bring in the amount for each one. Add it all up and see if you can get it to balance. So try it yourself, pause the video now, and then work through it with me. We can now bring this all into a trial balance. So the trial balance for Jim will simply be to take all those brought forward figures from each of our ledger accounts and say what ledger account it was and whether it was a debit or a credit balance brought forward. So for our cash, we had a debit balance brought forward of 9445. For our capital, we had a credit balance brought forward of 20,000. So you can check these from the ledger accounts that we just closed off. For our purchases, we had a debit balance of 3,500. We had sales with 4090 of a credit. We had rent of 700 of a debit. Non-current assets with 10,000 of a debit. Drawings 500 of a debit. Sales returns 50 of a debit. Purchase returns 80 of a credit. And discounts received 25 of a credit. So that's all of the balances brought forward from each of our ledger accounts, and lo and behold, when we add it up, it comes on both sides to 24,195. So that's what we get for our trial balance. Remember, this is just to check that we haven't missed anything or got anything wrong. If that didn't balance, we then have to go and try and find out why it didn't balance, check all of our ledgers, check all of our postings, and make sure there are no problems. Well, we'll look at that later on when we look at incomplete records. That then was our session looking at double entry bookkeeping. So how do you proceed from here? Well, what you need to do is learn your debits and credits, because those are crucially important. This will set the fundamental basis for the rest of your accountancy career. It's that important. You will use this as you move forward. No matter how complex accountancy gets, it always comes back to debits and credits. So it's worth watching this lecture over again several times so that you know that assets are a debit balance, that income is a credit balance, that capital is a credit balance, that liabilities are a credit balance, that expenses are a debit balance. And also that you know how to treat those various items like paying expenses, like what to do if a customer returns unwanted goods, how to treat early settlement discounts. That's all crucially important. It really does set the basis for everything you look at from here on in. Now, you may not be asked at this stage to post in everything like we've done and create a trial balance. It's more likely to be small sections of that you can look at. But by bringing it all together in the way that we have, you can see how it all links, how you record those journal entries in your ledger accounts. You then balance off the ledger accounts, and the amounts that you have as the balance can be checked by putting them into a trial balance. If it doesn't balance, we can then look for errors. We then bring forward our balances on assets and liabilities to next year and build on those. And we bring all of the rest, our income statement amounts, through as zero because that they won't have a balance brought forward into next year. So try the test your knowledge questions at the end of the chapter. Go back over this to make sure you can do everything and make sure that everything makes sense.